Hello traders, my name is Pete Stolzers and I have a very exciting strategy to tell you about. I've been in the business for over 25 years. My entire career has been involved with options trading, from being on the floor to being in the corner office of a brokerage firm to trading for a hedge fund to trading for myself to producing all the research within one option. This is one of the most successful strategies that you can use. And I'm going to divide this presentation into two parts. The first part, I'm going to go through all the details, the really important information that you need to know. This is timeless information. The second part, I'm actually going to go in real time and start looking for some put spreads. I'll look for some good examples. I'll look for some bad examples. We'll construct the trade. So by the time you watch both videos, you should have a very clear concept of what's involved in this particular strategy. I'll also say that there are times when you want to swing for the fence, and it's perfectly fine to buy calls and buy puts because there's a lot of certainty. When the market's moving all over the place and conditions are very volatile, that's when you want to focus on bull put spreads because you can distance yourself from the action, you can take advantage of high option implied volatilities, and you can take advantage of time decay. So let's start with a definition. First, I'd like to talk about naked puts. Many of you might be familiar with buying puts, and when you buy a put, it's a bearish strategy. You want the underlying asset to go down. When you sell a naked put, it's exactly the opposite. You want the underlying to at least stay flat or maybe move higher, and you'll make money in both of those scenarios. So the seller of a put has the obligation to buy the stock at the strike price. Now, you won't run the risk of having to buy the stock at the strike price as long as the stock stays above it. Let me use a very quick example. Let's say that the stock is at $100 and you sell a $95 put. That $95 put is $5 out of the money, and you will not run the risk of having to buy the stock at $95. Why? Because the person who owns the put can currently sell the stock in the open market for $100. Why would he exercise his put and sell it for $95 when he can get a better price in the open market? So our strategy will always be to buy back our put spreads before they go in the money. So we don't want to run the risk of assignment, but we'll talk more about that later. Many people get hung up on this because there's this notion of, oh my gosh, this is so risky. Naked puts, unlimited risk. This is really identical from a risk profile standpoint to a covered call. Everybody knows about covered calls where you own the stock and you sell a call against the stock. In fact, it's more conservative than owning the stock itself. Naked puts have exactly the same risk profile. So this is not a risky strategy. But when push comes to shove, if I sell a $95 put, I better be dang well ready to buy that stock at $95. It's just like being long the stock. You want to be long it for a long time, so you're happy selling a call against it. I just want to put that out there because this is really not a risky strategy. You just have to make sure that you do not over leverage. And you can also think about a stock that's moved, let's say from $95 to $100, and you go, oh my gosh, I missed that move. Doggone it. If I ever have the chance to buy that stock at $95 again, I'll do it. Well, by selling a naked put, you actually give yourself the chance to buy it at $95. And if you never get that opportunity, you're going to get paid a consolation prize because you sold that put for a credit. Now, we're not going to be talking about naked puts. We are going to use that same concept, but we're going to cover the position by buying a farther out of the money put option. That allows us to limit our risk and to reduce our margin requirement. And so if I sell the $95 put, I might buy the $90 put to cover the position and to limit my risk. This is a chart that I'm going to be using throughout the presentation, and it's nice because it has that $100, 95, 90 scenario built into it. And in this particular case, you can see that there was a defined support level at $95. My system gave us a buy signal in here, and we could have decided at that time to sell a $95 put and to buy a $90 put. Now, that $95 put is very, very close to the money because the stock was at $96 at the time. It only had to move 1 point for it to be in the money. In this particular case, this bull put spread would actually be quite bullish in terms of its bias. Because I'm so close to the money, I would have actually received a nice credit for that trade. Remember, I'm selling a closer to the money put, and I'm buying a farther out of the money put. And when I do that, I receive a credit for the spread. Now let's say that I wanted to play it more conservative, and I wanted to sell a $90 put, which would be way down here, and buy an $85 put. Well, now I've got plenty of cushion. I've got an extra $5 of cushion, and that trade turns from a more bullish bias to actually more of a neutral trade because I've got so much distance from where the stock is currently trading. And in this particular case, if you had sold that option and the stock made that kind of move, which it did, that $95, $90 put spread would lose a lot of value, which is great for you because if you sold it for $1.50, maybe now it's trading for 50 cents. So you could buy it back in and make a very, very nice profit. This strategy really tries to capitalize on a number of things: high option implied volatilities, time decay, and probability itself. So let's go through the definition of a bull put spread. I've talked a little bit about it, but the option strategy is also known as a bullish put spread. It's also known as a put credit spread. And as I mentioned, it's a neutral to slightly bullish strategy. If the spread is farther out of the money, it becomes more of a neutral strategy. If the spread is closer to the money, meaning it's closer to the stock price, it becomes a more bullish strategy. The risk is defined, and the margin requirement is lowered because we have bought that farther out put. And as I mentioned, the strategy takes advantage of inflated option implied volatilities, time premium decay, and the probability of success. And so here again, we've got our stock chart, and we're going to move on to the next slide because we're going to actually talk about the risk reward profile first. These are the key concepts that I'm going to be covering in the first video. The risk reward profile, the risk associated with bull put spreads, is the difference in the strike prices less the credit received. So if you sold a $100 put and you bought a $95 put, there's $5 between the strike prices. That would technically be my maximum risk on the position. However, when I sold it, I did get a credit for it. And let's say that I got a $1 credit for that trade. Well, I would calculate my maximum risk by taking the difference in the strike price, $5, and subtracting the $1 credit that I received. $5 minus $1 is $4. That would be $400 per option contract, or if I were trading 10 lots, it would be $4,000. So the most I can make on this spread is the $1 credit that I sold the spread for. The maximum risk on the position is $4. And so that begs the question, would you risk $4 to make $1? Most people would say, heck no. Why would I do that? Well, you can't really answer that question unless you know the probability of success. If the probability were 50-50, of course you wouldn't do that trade. Let's say that the probability of success is much higher. Let's say it's 90%. So there's a 90% chance of making $1, and there's only a 10% chance of losing $4. If you do that math, you get a positive expected value, and yes, the trade absolutely makes sense. Let's take a look at an option chain because I just want to review this whole concept of what we're selling and what we're buying and going closer to the money and going farther out. So here I've got the $95 options, got the $90 options, and I have the $80 options. There are the $85 options right in between here as well, but we're just going to take a look at some of the different prices. So let's say in that example that I sell the $95 put, here we can see that the bid is $255, the ask is $280. That's a pretty wide bid-ask spread. So let's say that we can get $2.65 for selling this put. And here we've got the $90 put, which is $1.50 by $1.70. Let's say we can get that, buy that for $1.65, sell this for $2.65, buy that for $1.65. We get a $1 credit for that, and we have $5 between the strike prices. So that would be a nice spread. We're fairly close to the money on that trade. Although right now the stock is up at $110, so we've got a ton of cushion. We got $15 worth of cushion. That stock can sell off $15 and we would still be okay on that spread. Now that's why these spreads are so effective and that's why they're so nice, is because you can distance yourself from the action, place your stop order, let time decay take care of the rest. It's an ideal strategy for working professionals who can't watch every tick in the market. It's also ideal for traders who really like a high probability of success. Now, if we go even further out of the money, you can see that the $90 put is $150 bid, and the $80 put is 55 cents offered. Well, we could easily get $1 for this spread. Unfortunately, there are 10 points between the strike prices. So in this case, I would have to put up a whole lot more capital because $10 less $1 credit is $9. So for this spread, I would have to put up $900 in margin. My maximum risk would also be $900. For this one, I only have to put up $4. So I've got $5 between the strike prices and I received $1 credit, $4. Now we can also take a look at the 90-85 and keep it to a 5-point. And here you see, well, I could probably get $1.60 for this, let's say, and maybe I could buy this for 90 cents. So there we're looking at a 70-cent credit for a 5-point spread. We are $5 further out of the money. So here we got $1, here we'd only get 70 cents. So you kind of see how the pricing relationships work. So let's review the margin requirement. Well, guess what? Margin requirement is easy. Now I'm going to quote you the exchange minimum margin requirement. Some brokerage firms actually tack onto the exchange minimum margin requirement. If you're dealing with a firm that tacks on, find another firm. You should only have to put up the minimum because your risk is identified in this spread. And I'll tell you why your maximum risk is identified in a second. It has to do with option rights and It'll be very intuitive when I explain it to you. So exchange minimum margin requirement is equal to the position risk. So again, it's the difference in the strike price less the credit received. Sell the 95 puts, buy the 90 puts for a $1 credit. Your maximum risk is $4 per contract. $5 between the strike minus $1 credit equals $4. So let's just take a step back and think about, why is it that this spread can only ever be worth $5? Well, let's say that there is some horrible overnight news and the stock falls to $50. That would be devastating. If you sold that $95 put, the person who bought that put is going to exercise their right to sell it at $95. They're going to exercise their right to sell the stock at $95 because it's at $50. Now, you actually bought the $90 put, so you also have the right to exercise your put and to sell the stock at $90. So effectively, you would be buying the stock at $95 and selling it at $90. Your loss is $5. Ah, but let's not forget, we did get $1 credit when we put that trade on, so our maximum loss is $4. It's very important when you go into these spreads to really have a clear understanding of what your risk is and what your margin requirement is. For those of you who already know it, I'm sorry to belabor the point. I just want to make this crystal clear. So let's talk about why the strategy works. It has to do with your odds of success. As I mentioned earlier, would you risk $4 to make $1? Well, heck no. Not if my probability of success is 50-50. But if it's 90% to make the $1, then here's how the math works out. 9 out of 10 times I'd make $1, so I'm up $9. 1 out of 10 times I would lose $4. So, given that probability, $9 minus $4, I have a $5 expected return. It would make sense to do the trade. The real key to success is to rarely take the maximum loss. And I'm going to show you how to avoid taking that maximum loss. Now, rest assured, there are events that can happen in the underlying stock that nobody can predict. So, let's say that it's FDA approval or just something devastating for the company and it gaps down overnight. That doesn't happen as often as you would think. But in those cases, yes, you would be taking the maximum loss on the position. One of the keys is making sure that you're not trading newsy stocks like that. So you can look at your probability curve, and this is actually a tool that's offered by most brokerage firms. I happen to use Interactive Brokers, and you'll see that the stock is currently at $110, and the probability, this area under the probability curve, the probability that it's going to finish very close to that $110 mark is very, very high. As we go further out to $70, your percentage might be 1.5%, 2% that it would finish at this level, and it would be about the same distribution up at this level. Now, a stock that has a very broad-based probability curve like this means that it moves around quite a bit. You can see from from 150 down to 70. There is a probability that it could reach that. Other stocks, you're going to see a very tight, high probability curve like that because they spend the majority of their time in a very, very narrow, defined range. I like to sell bull put spreads on stocks that are naturally volatile. Okay, not something that all of a sudden pops up and the option implied volatility spike, but something that always tends to move back and forth. And I like that because I'm able to receive a nice reward for the spread that I put on. I'm rewarded for taking that risk, and I can distance myself from the action. I'm going to just review the profit and loss graph very quickly. And again, we're going to use the same $95 put that we sell, and we're going to buy a $90 put. Okay, so here's what the P&L looks like. You'll notice that we have our break even here, and you'll notice that on the upside, our profitability is capped. It's capped at that $1 that we received for the put credit spread. And we'll never make more than that $1. Now, at $95, this is our short strike. Okay, we sold this put. Now, as the stock starts to move below $95 at expiration, let's say it's at $94.50, we're still profitable by 50 cents. When we get down to $94, now all of a sudden we hit our break even. Well, why is that? It's because we received the $1 credit. So that $1 credit comes into play here, and that's our break-even point is $94 at expiration. Now, every point that the stock moves below $94, we start to lose very, very steadily until finally at $90, we've hit our maximum loss on that position, which is $4. Can't lose any more money than that. So if we were to look out and I extended the price level here to $50, as I mentioned before, you wouldn't lose any more than that $4 for the reasons I described. So that's what your profit and loss picture looks like. Now, if the stock starts to move up, oh my gosh, you're in great shape because it's going to be further and further out of the money. Your probability of success is going to increase, and the spread is going to collapse, as they say. So the price continues to go down. You sold it for $1.50, maybe it's $1.20, then it moves to 90 cents. So you want that stock to move higher, but in all reality, there are many instances that you can win with this particular strategy. Let's cover those instances. The stock, let's say it was at $96 when we put the spread on, the stock can actually move lower. It can move 2 points lower, and we'll still make some money on that spread. The stock could simply stay flat at $96. We're going to make our $1 credit. The stock could move higher. We're going to make our $1 credit. So we've got 3 scenarios where we can make money on this. We have 1 scenario where we lose money. And so we need to do everything we can to put all of the odds in favor of not having this happen to us. And now I'm going to show you how to do that in a few minutes. Let's talk a little bit about implied volatility. What the heck is implied volatility? I hear everybody talking about implied volatility and IV, and what exactly is it? Well, it has to do with standard deviation. I'm going to keep this very, very simple because I don't want to teach a statistics course, but implied volatility, it measures the probability that the stock will move 1 standard deviation in a specific period of time. And that's calculated through the option implied volatility. Stocks that make big moves have expensive options. That should not be any surprise. Something that's whipping all over the place is going to have expensive calls. It's going to have expensive puts. A stock that flatlines and doesn't go anywhere is going to have very, very cheap options because it doesn't move, it doesn't go anywhere. Many traders search for stocks that have huge spikes in implied volatility. I can't stress this point enough. This is a very, very, very dangerous strategy. And you can't just go looking for option implied volatility spikes. That premium is there for a reason. It's not just a mistake. Believe me, market makers have teams, research teams, looking at the underlying stock. And when those option implied volatilities start to move higher, it's for a reason. It could be a pending lawsuit. It could be an FDA approval. It could be the release of a clinical trial. I don't have a research team. I'm not out there investigating it. There's uncertainty that's creeping into that underlying stock. They do have research teams. They don't want to get stuck. They know when there's uncertainty in the underlying, they start pumping up the option premiums. So they're there for a reason. And you don't want to get blindsided by an event. So by all means, avoid implied volatility spikes. That's just a sign of danger. Now, I like stocks that have naturally high occurring implied volatility. What do you mean by that? Well, some stocks, they just have a tendency to move all over the place. And they move up and they move down. Tech stocks are the classic example, and they aren't necessarily that newsy. Let's take 3D printing companies, for example. Half the investors think that 3D printing is going to be the next best thing since sliced bread, and the stock runs way up and the PE ratios get whacked out. And then you get another group of people who come in and say, oh my God, this is just a fad. There's going to be so much competition in this space and the companies aren't even making money yet. That's a huge sell. So the sellers come in and knock the stock back down. It naturally moves back and forth, and because it has that type of price movement, the option implied volatilities are high. Those are perfect situations. I love those types of situations because you know it's going to move all over the place. And in those instances, you can usually use technical analysis to increase your odds and the time when you're putting that put spread on. We're going to look at that. So those situations, I love it when it's naturally occurring. I do not want option implied volatility spikes. Another reason that option implied volatilities might spike is an earnings announcement. Oh my God, there's tons of uncertainty around that stock. It could move $10 higher, it could move $10 lower. Market makers aren't going to get stuck. They're going to juice those premiums up to high heaven to protect themselves. And if you think about it yourself, would I want to be out there selling call options or put options on Google before the earnings announcement? Of course not. The thing could move $50 or $100 higher or lower. I don't want to have that kind of risk. So that's why those options are very, very expensive. And if you've ever bought an option before earnings, and let's say you bought call options and the stock went up, you look at your options the next day and you go, oh my gosh, how is that possible? I bought calls, the stock is up, and I'm losing money on the trade. Well, that's because those options were juiced with implied volatility. So don't buy options before earnings announcements. I don't particularly like to sell options before earnings announcements either. I'm not going to advocate it. It's a very, very tricky strategy, but I can say that I have done it on occasion. So the higher option implied volatility allows me to sell farther out of the money bull put spreads. I can distance myself from the action. So the whole concept of implied volatility is just how likely is that stock to move one standard deviation. If the probability is high, the option implied volatility will be high. If the probability is low, the options will be cheap. Here are two examples. The orange line is the one that I want you to focus on because this is the option implied volatility. And you can see at 0.6, it's fairly high. That is a high option implied volatility. And that happens to be that $95 stock that I've been referencing. It is a tech stock, and you can see it's nice and constant at that $60 level. Well, the blue line is the stock's historical volatility. Okay, so you can see it has had a lot of moves, and the stock has a tendency to move all over the board. It's got a fairly high historical volatility. Now, if you take a look at another stock, it could be, let's say, a utility stock, or maybe it's a very, very uh, stodgy Dow stock. Let's say Cisco for many years, GE, Microsoft. I mean, these stocks chop back and forth, but they really don't move that much. Well, in those cases, this is an option implied volatility of 25. It's relatively cheap. Why? Well, look at the stock's historical volatility. It doesn't go anywhere. So if you're going to sell credit spreads on this type of stock, you could argue that, well, I'm not going to be taking a lot of risk because the stock never goes anywhere. But I would argue that you could have a surprise event, and even a $2 or $3 move could put you in trouble on this particular type of stock. So I want to distance myself from the action. I don't want to be selling something that's $1 out of the money on a $40 stock, hoping that it just continues to flatline. So just know that there are stocks that naturally have high option implied volatilities and stocks that have relatively low option implied volatilities. When I have a low option implied volatility, these are the calls and puts that I want to be buying because they're cheap. Time decay. So every option has two components. It has intrinsic value and it has a time premium component. I'm going to assume that you know what intrinsic value is, also known as parity. So if I had a stock that was trading at $100 and I had a $100 call, that call is at the money. And let's say the call is trading for $2. That $2 is 100% time premium. Okay, there's no intrinsic value there. If I go out 4 months in time and I buy a call, you can see that 4 months out to 3 months out, there's very little deterioration in that time decay. It barely starts to lose its value. As we go from 90 to 60 days, it starts to accelerate a little bit. From 60 days to 30 days, we start seeing noticeable time decay. And inside of 30 days, you see a huge drop off in that time premium component. Well, what does this chart tell me? It tells me that if I'm going to be selling options, I want to stay right in here. Okay, so I'm going to focus on this because I'm going to tell you where I like to sell options. The chart might tell you that, hey, I want to sell options in that last week right here because wham, that's where you get your biggest time decay. Oh, it's huge. And I'll tell you, yes, I do sell some weekly options. I normally stick to normal expiration because I find the liquidity to be better. But even 1 week out from normal expiration, yeah, I'll sell these if the conditions are right. But this is not the majority of my bread and butter. Why? Because I might be selling a 5-point spread for a credit of maybe 50 or 60 cents. So I'm not getting a whole lot for it, and I'm having to go closer to the money to take advantage of that. But if I sell something that's about 45 days out and I exit it when there's maybe 20 days left until expiration, you can see that I'm catching a nice part of the curve, but in this particular instance, the dollar gain on that spread is much higher. So let me illustrate. Let's say I sell it for $1.50 here and I buy it back for 50 cents here. I've just collected $1 and I had to put up $3.50 for that spread. Okay, so $5 spread, I collect 150. $5 minus 150 is 350. That's my margin requirement. Okay, and so in that time period here, I buy it back for 50 cents and I've made $1 on that and I put up $3.50. That's a very, very nice return. And I can exit the trade and move into another one and then go back out and take advantage of that same part of the curve. Also, by going farther out in time, I'm able to receive that credit and distance myself more from the action. And chances are, if I'm selling something that's 45 days out, I'll be able to go far enough out to where I have technical support levels that I can lean on. Very, very, very important concept, and I'm going to talk about that. So I'm not as gung-ho about going into the last week or the last 2 weeks because I've got to go closer to the money. I've got to put up a lot of money to capitalize on that. And options tend to be pretty resilient in the last few days. They don't whittle away at those premiums. And oftentimes you'll see something that is 10 cents bid offered at 20 cents. And you're like, geez, I don't want to buy that option back for 20 cents. You know, if you put it on for 60, you don't want to buy it back for 20 with 2 days left until expiration. So it takes a lot to get those options out. I love operating in this part of the curve, but be mindful that we do want to be selling inside of that 60-day window. So I would say 45 days out to maybe 20 days out is kind of your sweet spot. Market conditions, really, really, really important concept, okay? Because we're talking about bullish put spreads, okay? So we want to make sure that we have a tailwind. Whenever you hear me talk about a tailwind, it means I want to follow the trend. So we want to sell bullish put spreads on dips if the trend is moving higher. That's the ideal situation. So we're going to look at the long-term trend for bullish put spreads, and we want to wait for a market pullback. When we get that market pullback, that's where we're going to be looking to sell those bull put spreads. And there's something that's causing the market to pull back, so there is going to be uncertainty. All option implied volatilities are going to be increasing. So this is an ideal time for us to use the strategy. Again, remember, we want those high option implied volatilities. There's uncertainty. We want to distance ourselves from the action because the market's going to move around. Maybe it'll move a little bit lower. So we want to take advantage of all of those factors. Now this is a weekly chart of the S&P 500, and there's some things that I want to show you. First of all, I want to show you that the market's in a very, very strong uptrend. Okay, for the last 18 months. Folks, this is not a good environment to be selling out of the money call spreads, because at any moment you can get one of these massive rallies in here. I want to stay with the trend. Okay. The other thing that you'll notice is this is the VIX that I overlaid. And you'll notice we get a little bit of a pullback here. Look what happens to option premiums on the S&P. They spike because there's uncertainty. Well, hallelujah. That means we get very, very well rewarded for selling bullish put spreads, and we can distance ourselves from the action. Now here's the bounce in the market, and look what happens to the option implied volatilities. They collapse. So when the market rallies, option premiums have a tendency to go down. Okay, since the market is in an uptrend, you get a nice rally like this, and some people will look at this chart and go, ha ha, rally, stalling out a little bit, maybe I'll sell some call spreads here. Well, look what happened to the premium. The bottom fell out. So if you sell a call spread right up in here, all you need is for the market to continue. Okay, maybe it does one of these where it comes up and it starts resting, and you say, yeah, oh, look, resistance, I'm going to sell a call spread. Well, the volatility is down, and then you get that kind of move and huge risk against you. So in a market that's trending higher, you want to focus on bull put spreads. You'll also notice this 100-day moving average in here. When the market comes down and challenges that 100-day moving average, you don't want to be the guy. There's a market adage, and I actually have this on my trading desk. It's the second mouse gets the cheese. So think about it. The first mouse goes and gets caught in the mouse trap, he dies. But the second mouse comes and get the cheese. You don't want to be the one picking bottoms. You have to make sure that that support level is in. And so the market dips below the 100-day moving average. Well, once it rallies back above it, now we're still in a very sweet spot, and we've got that support level to lean on. We've got a trend, we've got a major moving average. That's your put selling opportunity right in there. Okay. That's a good selling opportunity. That's a good selling opportunity. That's a good selling. Look at all these right in here. And we have been, and I've been telling subscribers all the way, this is when you want to be hitting that strategy and hitting it hard. And you're still able to distance yourself from the action. So, yeah, it's scary. Something's going on in here. Something's going on in here. Everybody's freaked out. And that's also, you break down here below the 100-day moving average. Well, you don't start selling them until you get the rally back above it. This is actually a 200-day moving average. So yes, you could have sold here once you saw it bounce back above the 200-day moving average. So you have to use just a little bit of common sense, not a lot. This is really, really not that difficult. So you got to, let me step back and tell you about market conditions one more time. Very long term, very strong uptrend. You should know that when the market dips, I need to be focusing on bull put spreads. If the market were selling off like it did in 2008 and 2009, then you want to be focusing on selling out of the money call credit spreads. The whole implied volatility situation will be much different because option implied volatilities will be much, much higher even when the market rallies in those instances. But right now, the market's going up. I'll also tell you that I love selling bull put spreads because the market moves higher twice as much as it moves lower. Well, how can that be? Just look at the chart. If you looked at any long-term chart, the market has a tendency to grind higher. When it falls very quickly, and the selling is over, and then grind higher. So your probability of success on a bull put spread is, I believe, much, much higher. Because remember, the underlying can move a little bit lower, it can stay flat, or it can move higher. We win in 3 out of 4 scenarios. And if the tendency is to drift higher, then we know we have that tailwind working in our favor. So you must know what the long-term market trend is. So what are the ideal stocks? What should we be looking for? Well, the market's in an uptrend. We want to see stocks that are in an uptrend. We don't want to be out there bottom picking a stock that has been in a long-term downtrend. What if a stock is in a long-term uptrend and it's had a dip? Absolutely, we want to trade those. Those are great because the stock will find support and eventually it'll get back on its long-term uptrend. So yes, those are great candidates. We want to focus on stocks that have naturally high implied volatilities. Just like I said, no spikes. And the way that we avoid those big gaps down is to avoid newsy stocks, avoid earnings season, okay? Earnings announcements. After the announcement, fantastic. I love to sell put spreads after earnings announcements, especially if the stock is reacting well and the news was good. Absolutely love it. Biotechs. I do not like selling put spreads on biotech stocks. Why? Because somebody comes out with a new drug. Oh no, there's competition. Gee, the clinical trials didn't go quite as well as we expected, and the stock gaps down. Too newsy, too news driven. And you'll see other companies that might have pending lawsuits and they just, they gap up, they gap down. You look at a chart and you see a bunch of gaps in it, stay away. You don't want that. We also want to focus on stocks that have defined support. And the reason for that is that we are going to lean on the support level. Okay? I always like to have support between the stock price and the short strike price. And that way, when that support fails, we exit the trade. We don't wait around to see what happens next. We were leaning on that support. We're still out of the money. Support fails. We buy the put spread in. Yes, we might take a loss on the trade, but we're going to move on. We're not going to think twice about it. We also want to look for stocks that have relative strength. What do you mean relative strength? I want to see a stock that's moving higher when the market's flat. I want to see a stock that's moving higher when the market is down a little bit. Because when the market finds its footing and the market starts to move higher, that stock is going to skyrocket. And I'll show you how we can find that very, very easily. In fact, I will overlay the S&P on one of the charts. We want to find stocks that are on a buy signal. Now, if you have other indicators that you use for stocks, more power to you. But I'll tell you that I've spent 7 years developing my stock system. It's fantastic. When I see a stock that's above a support level and it's on a buy signal and it's moving higher, that's all I really need to know. I'm ready to go into action and sell my bullish put spread. We also want stocks that have performed well with the system. And again, in future videos, I'll show you exactly what I'm talking about. Well, all we're doing with all of these is it's like check boxes. And the little check boxes are just all increasing our probability of success for each one of these trades. So the more we can mark off, the better our chances of success. We want to have stocks that have good option liquidity. That's pretty intuitive. You don't want to sell options when there's a 30 or 40 cent bid-ask spread, and you'll have a hard time getting out of that if the stock does move against you. I said it earlier, we don't want to put bull put spreads on before an earnings announcement, but afterwards, absolutely. So let's look at a couple of examples just to try and nail down what I've been talking about. So you have a stock that's in a downtrend, okay? Now we don't know the full picture. Let's assume that the 2-year and 3-year outlook on this stock is a lot better because this is pretty dang steady selling. So I never want to be the first one on the big drop to call a bottom on it. But in this case, the stock has actually formed a pretty decent base. This A means that it was an earnings announcement after the close, and it held up pretty well throughout that earnings announcement. We have a defined support level right here. So, not too bad. Got the stock forming a little bit of a base here. We get a buy signal. Okay, well, we can sell a put spread. And this is, let's call that $62. We could sell looks like that support level is at $53. That's 50. So maybe we sell a 50-45 put credit spread. Okay, makes sense. We got our buy signal. We got a base that's formed. Now we get a sell signal. That's our first warning from the system. You should buy that spread back in. Let's say that you didn't have my system and now you broke that technical support right there. You should be reeling that spread back in because your support has been violated. Now it hasn't moved that much against you and a few days have elapsed, so maybe you can break even on it, but you need to reel that thing in right there. Now you get the big gap down. Okay, I'm not as crazy about this whole setup, and I'll tell you why. Because if I've got a stock that's been in a downtrend like this and it forms a base, I don't get excited about it until it can move above that horizontal resistance level right there. Then I get a little bit more excited about it, and then I would feel comfortable selling that strike price right there. But I didn't have that. So you need to have that breakout. So let's move forward in time. Ah, gosh, stock gaps down, looks really ugly. Now we have a higher low. There's the low, we have a higher low. That's pretty encouraging. Oh, hey, look there. We got a buy signal on it. Ooh, that could be a good entry point. But again, we don't want to be caught in this same trap here. If I were super aggressive, yes, I could sell a put spread there and I would sell it below that level, which is probably $33 or so. So I'd make sure that I have that low to lean on. I mentioned earlier, I like selling put spreads where the stock price is higher than the support level, and the support level is higher than my short strike price. So let me rephrase that. Let's say that I sell the $33 put right here. I have technical support between the stock price and the short strike. And that would be my technical support right there. Okay, I have to say this again. I want to make sure that there is technical support between the stock price and my short strike price. The reason for that is that if this technical support level fails, I will know that I was wrong on the trade and it's time to buy that spread back. No questions asked. That is my discipline. Okay. But again, as in this situation, I'm not as excited about that buy signal. But now we actually move through resistance. That's horizontal resistance. Okay, now I can feel pretty good about that trade. And I might sell a put spread with this $35 strike price, which is pretty much right on that support level, or I could go down to 34 or 33 to give myself a little bit more protection. But this is my no fail line in the sand. I want to make sure, excuse me, that the stock does not move below this price level. If it does, I buy my put spread back. Well, this is a pretty nice breakout. And if I look at this chart, I'm guessing that the stock probably, whoops, sorry, I keep clicking, moves higher and higher and higher and higher. Okay, that's a nice breakout right there. And it also helps if we've got volume. I stripped volume off of the chart, but if we had nice increasing volume, that would be another good situation. So in general, I don't like stocks that are trending lower like this. Okay, this is not my favorite candidate. And I will not touch any of these on a big drop like that until support has been defined and the stock has been able to move back up through a resistance level. Okay, and I always make sure that I have support between the stock price and my short strike price. And when that technical support is breached, I buy it back. No questions asked. So, yes, much more to my liking. Stock is in an uptrend. Oh, yeah, I would much rather sell put spreads on dips for a stock that is in a long term uptrend. Now, in this particular case, I did overlay the SPY, and you can do this in the platform very easily. Just type in the symbol, and you'll see a box that says, do you want to overlay a chart? And in this case, I put in SPY. Now, what we'll see here is the stock is moving higher. Well, what's the market doing? Market's selling off. Ooh, that's a strong stock. It wants to run. Okay, we get another market sell off, and the stock does start to move a little bit with the market, but overall, it's been able to hold that move higher. It's been moving higher when the market is moving down. Great. I love that. So let's take a look at the technicals on this particular stock and see where we might be selling put spreads on it. So the stock rallies up and then it gets into a consolidation phase right here. And then it breaks out. Ooh, we like those. We like breakouts to new relative highs. Okay. So the stock continues to move higher. And this is our support line right here. We want to make sure that that opening price holds and that the stock doesn't come back below it and fill in that gap. Well, we get a buy signal right here. For me personally, I could sell a put spread right here, but I like to give it a little bit more time to see if it'll come back and test. We get, a little bit of choppiness, a short, stop, long, stop, short, and then here we get a decent buy signal here. Now I like this, and you can see that the stock has gone basically nowhere, right at that $50 level. But look what the S&P has done. I mean, it just tanks. And if you got the S&P tanking and this stock is treading water, that is such a bullish sign because as soon as the market recovers just a little bit, zoop, there goes the stock. Beautiful. And we know that we've got this support level that we can lean on. Let's call it a 47.50 put that we would sell, and we'd buy the 42.50 put. And all we got to do is bide some time here, and that spread will work out really, really well for us. Okay, and we never even came back and touched that. We're never even close to it. And now the stock continues to move higher. That put spread would expire. Now we get another market sell-off. Well, huge market sell-off and the stock still holds its own and it's still holding the support level and we get a buy signal right here. Okay, we can come back in and lean on that one more time. And then there the market recovers and there goes the stock. Now we actually have another trade that I would consider, which is a breakout to a new all-time high. Now these are very powerful moves. Boom, 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 boom. We can expect that stock to go higher. I would have no problem selling a 55.50 put spread as long as it can hold that breakout. And we're fairly close to the money. That would be an aggressive trade. That would be a trade that has a bullish bias as opposed to a neutral bias. If I wanted to keep it very neutral and really play it safe, I could come down and sell something at this level, but I'm not going to get rewarded very well because I'm so far out of the money. Safe, yes, but not going to make a whole lot of money on it. And for some of you, I mean, if you can, I like making a 25% return on my credit spreads. For some of you, you might be happy with a 10% return if you can do it more consistently. So it really, how close you go to the money really depends on your comfort level and the consistency that you're looking for. I have a tremendous amount of confidence in my trading signals, so I lean on them heavily. They're right very, very often. Here's another great looking chart, okay? So you got a stock that has this base in here. Beautiful buy signal in there, by the way. Has a horizontal breakout. Really, really strong. Then we get an earnings gap. B means before the open. And now we've got the stock really wanting to move higher. We get a early buy signal and we get another signal here. We get buy, stop, another buy signal. You can start getting long in here because this stock is continuing to push higher and you would use this. So we would sell the 70 puts, buy the 65 puts, and we would use $70 as our stop, that low right there. That turns out to be a nice trade. So again, we've got a nice technical breakout, lots of strength. Now we have an earnings gap. Huge news on that. Another good piece of news, and those option premiums are going to stay fairly inflated. They'll come out right after earnings, but they'll still be relatively high on a move like that, so you'll get rewarded well. Nice chart. Market's in an uptrend. Stock is in an uptrend. Stock is breaking out. Stock is gapping. All good components for the trade. I might have one or two more of these to go through and then we'll continue. So here we can see a stock that has come down had that same consolidation formation that we did earlier, and we get a gap down. And now we're below that support level right there, which is bearish. Okay, that's a big sell-off. Something's going on. This is not a good looking stock. So we get a little bit of a V bottom, maybe a little bit of a capitulation low. There's our buy signal. We need to jump in on that because we got a buy signal. No, we need to move through that resistance level and be up in here before we put that trade on, because there's a very good chance that that resistance level will fail and the stock will roll over and continue to head lower. So I can't stress this enough. You've got some weakness. Weakness means danger. Be very, very careful. This stock could take a while to put the base in, and we need to have confirmation. Once it breaks above here, then we can feel pretty confident selling our put spread below that breakout. And let's call it 87.50. So if the stock, we sell an 87.50, 82.50 put spread, maybe we do an 85.80, something like that to give ourselves even a little bit more protection. But if it breaks this level right here, we're buying it back, because our thought is now that it's broken out, it's going to continue to inch higher and it'll fill in this gap. Well, if it doesn't and it rolls right back over, we were wrong. We got to admit that we're wrong, reel it back in, keep your loss very small, and know that you have a chance to hit on the next one. Be directional. What does that mean? It means that when I put my spreads on, yes, they can be neutral if I'm way out of the money. I have no problem putting them on closer to the money and actually having a bullish bias, because I put all of my check marks along the columns to make sure that, yes, I'm following the market trend. Yes, it has naturally occurring high implied volatilities. Yes, I have a technical support level between the stock price and the short strike price. Yes, I'm on a buy signal. Yes, the system has performed well with it. No, the stock isn't newsy. I get all of these things working in my favor, and I form an opinion. Have an opinion. If you cannot look at a stock and form an opinion on where it's going, move on. Look for another stock. There's only 3,000 of them that have options on them. You have to have an opinion. The stronger and better your opinion is, the more successful you're going to be. So use bull put spreads as a high probability directional trade. It will be higher probability than buying calls, because if the stock flatlines for a while, you're still going to make money on a bull put spread, because you're going to be capitalizing on time decay, where if you were a call buyer, you'll lose money because you're going to lose time premium. Now, these are the check boxes that I had mentioned earlier. Have as many of them marked as possible. Here's my final note. Do not trade iron condors. That would be a strategy where you come in, you look at a stock, and you go, I have no clue of what this stock is going to do, so I'm just going to sell an out-of-the-money bull put spread, and at the same time, I'm going to sell an out-of-the-money call spread. So I'm going to sell a bull put spread and a bear call spread. Another way of thinking about it is I'm going to sell a bullish, I'm going to sell a put spread, and I'm going to sell a call spread. So I'm basically saying this stock is going to flatline. All I can tell you is I've been in this business for 25 years, and there are a lot of people touting this strategy, this whole iron condor strategy on indexes and every other possible underlying. I will tell you that I've watched thousands of option accounts that were my own customers, and invariably, you go through a successful period. and you're making nickels and dimes and you're whittling away and you're feeling pretty good because you're consistently making money, and then wham, you get nailed. Wham, you get nailed again. So 6, 7 months, 8, 10 months worth of profitability gets wiped out in 1 or 2 trades. And if I think about it intuitively, what profession on this planet can I go into and be successful without having any possible opinion of what I think is going to happen in the future? I don't care if you're in clothing, if you're in manufacturing, if you're in the restaurant business. If I can't form an opinion of what people are going to want to eat or what menu item is going to sell or what location I should have or any of those variables, I'm going to lose money. And it's the same way with iron condors because you're saying, I have no clue what's going to happen. I'm going to sell put spread. I'm going to sell call spread. I'm going to hope the stock stays in this range and time decay will whittle away at it. And then lo and behold, the stock makes a move and you're forced to cover. And then you'll hear these traders go, oh, well, here's how we adjust the delta position. And we go and if the stock rallies, we're going to pick up deltas buying the stock, or if the stock sells off, then we're going to short some stock to pick up some deltas, or then we're going to move and sell a lower call spread closer to the money. And those are our damage repair strategies. And then they'll woo you over with delta gamma neutral and adjustments. And what a mess! It's ridiculous. I've been in the business a long time. People that have directional opinions make the most money. Okay, they also take risks and they also are going to be wrong, but when they are able to form an opinion and be right more than they're wrong, their profitability is huge. This is just these iron condors and repair strategies to me are complete nonsense. So try them if you will. Don't take my word for it. I've tried them myself, and trust me, use these bull put spreads and have an opinion. And I'm not saying that it's wrong to sell premium. I love to sell premium, but do it in a directional manner where you have an opinion on the underlying. And there might be other instances where I want to sell out of the money call spreads. And I will do a video on that as well. But I'm not going to do it on the same stock at the same time because that means that I have no directional opinion. Okay, so on stock ABC, I might be bullish on it and I'll sell a bull put spread. On stock XYZ, it might look absolutely horrible, and I'd be very comfortable selling a call spread on XYZ, but I will not do both strategies on the same underlying. Structure the trade. So ask yourself these questions and devise your game plan. Why do I feel good about the stock? What is it that tells me that this stock is going to move higher? Okay, I talked to you about stocks that are in a downtrend, have formed a base. Well, you better make sure that that stock has been able to get back above a horizontal resistance level. You also want to see the volume starting to pick up on that bounce. That tells you that the stock may be poised to rebound. And hopefully it's a situation where the stock is in a 2 or 3 year uptrend and it's just had a very weak 3 month period, let's say, and now it's trying to rejoin that long-term 2 or 3 year uptrend. That's a good situation. Just make sure that that low is in and that you do have a support level that you can hang your hat on. Now that would be a reversal trade, okay? Long-term uptrend, stock goes through a little dip, starting to regain its footing. Now it's going to move back up and rejoin the long-term uptrend. Just know what you're dealing with. Now a continuation trade would be a stock where you have a 45-degree angle from lower left to upper right. The stock, like this in the background, is on a mission. Boom, 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 boom. It's just going higher. It has breakouts, it has gaps. If you're in a continuation trade like that, Those are really good for bull put spreads. You just want to make sure, again, that you've got a breakout or some horizontal support level that you can lean on. Do I have a tailwind? Is the market in an uptrend? Is the market above a major support level? I'm also going to be using that support level as a gauge of what's going on in the market. Are the IVs, implied volatilities, above 40? And that's nice to be able to have a stock that's got at least a 40 IV. Every brokerage firm has implied volatilities for the options. In the platform, you can easily find that information out as well. Will the stock be announcing earnings? If so, don't put the spread on. Wait until after the earnings announcement. Even if you put a credit spread on just before the earnings announcement, chances are those options are going to retain their implied volatility really, really well because they won't suck it out until after the actual announcement. Does the stock have relative strength? So as we looked earlier, how has it performed relative to the S&P 500? S&P has been moving lower, stock is treading water. That's a very, very good sign because you know as soon as the market starts to find its footing, the stock is going to spring higher. Does the stock have a support level that I can lean on? I've beaten this dead horse long enough. You know what I'm talking about. It doesn't have to be a horizontal support level. It could be a trend line that you're leaning on. It could be a major moving average like a 100-day or a 200-day moving average. Those will all work. Are the options liquid? Make sure that you can get in and out easily. Also, make sure that you're working the bid-ask spread. So if you see that there is a 20-cent bid-ask spread on each of the options, that adds up to be a 40-cent bid-ask spread on the spread itself. You should be able to get at least a dime, maybe 15 cents better than what the bid price is on that spread. We'll review this a little bit more when I'm actually doing trades and showing you actual trades and going through my analysis, but make sure you're working the bid-ask spread. You can always do better than what's on the screen. Again, this pertains to my system. Is the stock on a buy signal? We want to make sure that we're following the signals on the trading system. Where will I place my stop? Before you enter any trade, I don't care what your strategy is, if you're buying calls, you're buying puts, you're doing bull put spreads, anytime you enter a trade, you must know where your exit point is. So you always have to know where your stop is. The logical place to have your stop for bull put spreads is at a technical support level. Let time work its magic. So I mentioned earlier that this is one of my favorite strategies. And the reason for that is that the market goes up twice as much as it goes down, or it goes up twice as often as it goes down. You've often heard of the analogy that the market takes the stairs up and the elevator down. Well, it spends most of its time grinding higher. When it does fall, it tends to fall very far, very quickly, and those moves tend to be brief. When I'm selling bull put spreads, I make money if the stock moves down just a little bit, if the stock stays flat, or if the stock moves higher. Those are three scenarios where I win. The only time I lose is if the stock moves down considerably. So 3 out of 4 scenarios, I'm a winner. That makes this a very nice strategy. I had mentioned earlier I don't like selling call spreads in an upward trending market. The reason for that is that when the market makes a surge higher, option implied volatilities decline precipitously, and I'm not getting rewarded for the strategy. Plus, I'm trading against the long-term trend. Never wise to do that. One other thing about selling call spreads is that at any moment you can get blindsided by the Fed. I've seen this happen so many times in the last 25 years, I can't even tell you. And the kicker is the Fed and central banks around the world, They love to make major announcements the Thursday before option expiration because they know they can catch everybody that's been short calls off guard or long puts, and the market just screams higher. That's when they can get their biggest bang for their buck, is by making those major announcements. So they might come out with some type of easing, quantitative easing, anything. If the market's in trouble and they come out with a major announcement, it's going to fuel the market higher. And if you're short a call spread, oh, you are going to take a lot of pain. So that's another reason that I favor bull put spreads over selling call spreads. Bull put spreads are ideal for working professionals. So you can use my system as a guide. You can find the stocks in a matter of minutes. Use the guidelines I've outlined. You execute the trade. You place your stops. And then you let time decay whittle away at the position. You can go about your business, and if you're far enough out of the money, the stock can move up and down. You don't really care because you're far enough out of the money to where you don't have to sweat it. You don't have to worry about it. You don't have to watch every tick. You can just take a look at your computer at the end of the day and go, okay, good. I'm still $5 out of the money. I'm still $8 out of the money. And then watch the premium gradually collapse. The thing is that when you do have the option implied volatilities collapse, the stock moves higher, you do need to buy the option back. Okay, so take profits at some point in time. You don't have to drain every nickel out of the strategy. Release the margin, look for your next new trade, or roll into the next expiration month. I also want to mention that you should avoid letting the options go in the money. So if the stock is below your short strike price, you should buy the spread back because there's been a technical support level that you were leaning on. It's been breached. Your analysis was wrong. Take your lumps, move on. There'll be lots of other trades, and don't let it turn nasty. If you get caught on a stock that does gap down on you, know that based on how you're going to get assigned and how you're going to exercise your options, that $5 maximum will come into play, and then you get to subtract your credit from it. So your worst case scenario will really be defined, as I mentioned earlier. And if you're wondering about when you might get assigned on your short put, as long as there is a little bit of time premium in that option, meaning that that option is trading above intrinsic value, you don't run the risk of being assigned on it. Be very, very rare to get assigned on an option that still has premium. I'm not going to get into the details of that. You're just going to have to trust me on it. When the options are trading at a discount, and in other words, they're trading below intrinsic value, below what's called parity, then you definitely run the risk of being assigned. But that is typically when the option is $5+ in the money. I mean, you're way in the money and you're getting close to option expiration. So make sure that you stop when that technical support level is breached, and you should still be out of the money and you'll never have to worry about that. Also want to mention avoid newsy stocks. Okay, avoid biotechs and you'll almost eliminate the overnight gaps. So just look at a chart, and you want to make sure that you're not seeing any huge gaps on that chart, especially gaps down. And if you do that, then you should be in pretty good shape. So I'm glad I had a chance to record this video. Lots of information in it. You might want to view it a couple of times. I did go through a lot of basic concepts. In the next video, you have all the information you need now. Now let's go find some trades. Let's take a look at a bunch of different charts, and we'll see some excellent candidates and we'll see some bad ones. By the time you're done watching the second video, you should be able to put all the pieces together. This is a really, really good strategy. And for people who are active investors, it's fantastic. Like I mentioned earlier, it's one of those strategies where if you mark off all the check boxes and you know what your exit plan is and you know where your stop is, put the trade on, put your stop in, let time take care of the rest. Thank you, and I'll look forward to describing good trades in the next video.